Hello, everyone, and welcome to another episode of Money Mantra. Over the last 5 consecutive months, we have seen Nifty and Sensex give negative returns. Are you worried about markets going down? Where should you invest in this market cycle? Don't worry. Tata AMC has come up with a new fund offer focusing on BSE Quality 30 Index. And to understand more about this offering, we have with us Miss Shelly Gang, Head Products at Tata AMC. Shelly, welcome back to Money Mantra.
Hi Harsh, thank you, and thank you Team Manify and the viewers. Pleasure to be here.
Great. So, you know, we'll before we start with this, talk about the NFO. Shelly, why don't you give us some perspective about, what is this smart beta strategy?
So smart beta funds have gotten popular in the last few years, yes, and they are one of the buckets of passive investing. Like you have market cap based funds, you have sector and thematic funds, you also have factor funds, factor investing, and factor based funds. In the search for what drives risk and return, the factors were discovered. So value, quality, growth, size, dividend yield, low volatility, these were the factors discovered, and momentum and alpha came in later. But the entire idea was to discover and describe how, what are the risk return, or what drives risk and return of a particular stock and of various stocks. So that's the idea of smart beta investing. Each factor that we spoke about and that I listed has various matrix basis which a score is calculated for each of the stock for each of those factors. So, for example, if it's a low volatility fund, then a low volatility score is calculated for each of the stocks, and then the top stocks are taken. If it's a quality fund, then a quality score is calculated for each of the stocks basis on some matrix, defined matrix, and then the top stocks are chosen. So that's how the smart beta funds work.
So, we are talking today about the quality index, specifically. So, what are these factors, which, define the quality of any particular stock?
Yes, it's very important to understand how is quality defined. But just as stepping back a little bit, on the analogy, for example, if someone wants to buy a house, you would want to buy it in a good neighborhood, and you would want to buy a good quality construction house. That's quality buying in case of a home purchase. Similarly, if you are building a cricket team, for example, you would want to have high quality players consistent with good track records to win matches, basically. So you would need that kind of players with high quality talent and such things. So that's the high quality bit, when you're building a cricket team. Similarly, when it comes to quality in investing, it is about identifying stocks which have particular fund or which are good on particular fundamental characteristics. And that is when we can say that yes, these are quality stocks. These characteristics are should be is actually high profitability, showing good operational efficiency, basically the robustness of the company. So these are the things which define quality in investing. If you were to specifically talk about BSE Quality Index, BSE Quality Index takes three metrics into consideration: return on equity, which defines how well the company deploys or is efficiently deploying its capital. The second one is accrual ratio, which indicates the quality of earnings, and it indicates that how much of the sales have happened by cash and how much is by debtors. Obviously, anybody would want high cash sales, which shows a better quality of earnings. So that's the second piece. And the third metric is financial leverage, which is debt is to equity. Any company which has a lower debt equity ratio is considered to stand the test of times, even when interest rates are higher or suddenly have peaked out. So ROE higher the better, return on equity higher the better, accrual ratio lower the better, which means more sales have happened by cash. And the third is financial leverage, again lower the better, which means lower debt on the books. So that is how quality is defined under BSE Quality Index.
Understood. So while we understand, how the quality is now defined, but how is this index, constructed? So this index would have around 30 stocks. So how would the fund manager or the, index provider come up with these 30 stocks?
Sure. It's very important to again understand the methodology of the index. Now that we understand quality and how is it defined, so the base, the universe of this index is BSE Large and Mid Cap 250, which means the large and mid cap stocks are the universe which come in. Uh, the quality score, a consolidated quality score, is calculated for each of these 250 stocks. And how is the consolidated quality score calculated? For each stock, an ROE score, accrual ratio score, and a financial leverage score is calculated, and an average is taken. Equal weightage is given to each of these three metrics. So, an average is taken of all these three metrics to come up with the consolidated quality score for each stock. And likewise, you will have 250 scores of 250 stocks. The top 30 stocks by quality scores are selected. Very important to understand, the scores obviously adjust for higher ROE the better, lower accrual ratio the better, and lower debt to equity the better. So it is accounted for in that manner itself. So the top 30 stocks are now selected basis the quality score. And how are the weights given now? So let's say that two stocks have similar quality scores, but the stock which has a higher free float market cap would be allocated a higher weight. So the weight allocation is in conjunction with the free float market cap multiplied by the quality score. Both the things are considered while allocating the weight. One important part of the methodology is that there is a stock cap of 5%, and then there is a 30% sector cap. This helps the index to remain diversified, and sector cap and stock cap both help in the diversification of the index, though quality is actually more inclined or attracts sectors of defensive sectors of FMCG and IT. If you look at the historical sector exposures, you will see that FMCG and IT are two sectors which have decent and they have always have had large exposures into this index. Now, alongside, I would want to also mention that quality, because of the parameters, the fundamental matrix that it uses, the ROE, accrual ratio, and the financial leverage, these three ratios that it uses to identify high quality stocks, it tends to attract these two sectors or defensive sectors largely. And these defensive sectors have higher probability and predictability of returns, basically. Also, stability of returns coming. And that is why quality as a factor tends to outperform during down market periods, basically. So, of course, there are business cycles, there are market cycles. Quality tends to, when we talk about market cycles, quality as a factor tends to outperform during down market phases and periods. And down market phases can occur because of geopolitical events, because of, let's say, US Fed announcements, or any other reason, global or domestic. So, and if the investors believe that the market journey or the journey of the market will have these market down periods in between. Of course, we all believe and we all know that India is a growth market, and the Indian equity market's trajectory is upward linear. But this linearity is not a straight line, right? It is actually
Correct.
strewn with some down market periods. So that is where the role of quality. So if we all believe that there would be down market periods coming in between, that is where quality falls lesser, tends to fall lesser, and outperforms and gives the downside protection. And it is able to capture a decent upside as well.
Correct. So, Shelly, as you explained that this is a passive strategy, and it kind of removes a lot of biases when we look at fund or a stock picking. So at one side we have these passive funds, and on the other side we have these active fund managers who
Mm-hmm.
largely are wanting to also capture the quality stocks when creating their portfolio. So
Right.
how what is the difference, if I would say, between a fund manager picking up a stock and the stock selection through this process?
So actually, active fund management is judgment. If I were to describe active fund management in one word, it would be judgment. The fund manager talks to the management of companies, try to understand the industry dynamics, have his own views on how the industry will pan out, have his own views on how this company will be performing on the sales, on the top line, on the margins, as compared to, let's say, the others in the industry. Also tries to judge on the consistency of the commentary coming in from the management, and tries to see whether the quarterly results are in sync with whatever commentary, quarterly commentary has been given by the management. So all these things are formed for various stocks on a judgment basis. Now, this is a parallel route to investing. We never, as a house, we always believe in active and passive rather than active versus passive. Now, like active can be broken down into homogeneous categories. Within each category, a judgment is applied. So you have very broad guidelines for each category, and then within those guidelines, the fund manager applies its own judgment and forms a portfolio. Even allocation of weights is by judgment. And you should also think about it that it's not that if a stock has a 7% weight, it just gets allocated at one go. There is a position sizing and happening, which where the fund manager tries to take 2%, then again adds position because his conviction is higher, is built suddenly market conviction, some bit of market consensus comes in. So that's the active part. On the passive side, we have three buckets. So you can look at the passive investing route from the lens of market cap. They have their own rules, sector and thematic, largely which for any theme which basic industries will come in, or for any sector which basic industries will come in. That's the broader rule. And then you have market cap rule, stock cap rule, everything coming. And then the third lens is the factor investing. So those are the three lenses. There are homogeneous categories. These are two parallel routes. One is judgment, one is passive rules. Now, in passive, it is very, very important to understand which part of the market are you going and making, and capturing that part of the market through passive. That's very important to understand. Yes, passive is all about replicating the index, but it's important to know which part of the market is being looked at and focused on and picked up for making rules on that. That defines the risk return profile of the passive fund also. So these are the things. Passive is passive, but it's not static. Each index also undergoes its changes. Like Nifty 50 undergoes its own changes to continue to represent the economy, very well in a very justified manner. So it also undergoes changes, and likewise all other indices also undergo reconstitution and rebalancing, and they run the rules every 3 months and 6 months, and stay true to the rule that which portfolio should come out. So these are two parallel approaches, and I have just tried to highlight the differences in the both while explaining what each one stands for.
Correct. I think a lot of time the advisors come into play when helping their investors to get into the right phase of the market when investing in such strategies. Correctly said. So, coming back on the questions related to NFO, if any investor were to invest in this NFO, what are the kind of benefits that he will kind of get while investing in this fund?
So, right, as I said, quality tends to outperform during down market phases, and everybody wants a diversified portfolio. So, like in India, momentum as a factor has done very well over the last many years. And if you look at long period returns, just on the return perspective, momentum as a factor obviously is high there. very well, quality as a factor is able to do a good job there. It falls less during deep corrections or even flattish markets. Also, it outperforms. It has a better risk-adjusted return number as compared to other factors, and even as compared to its own universe, the large and mid cap 250. So, and it gives a great investor experience because the standard deviation is also low. So, if the belief is that the journey of the market will be with bull phases and flat phases and bear phases also, then obviously you need to take care and have investment avenues in your portfolio which would outperform during bull phases. Let's say when we're talking factor investing, it is momentum, and which will also outperform during bear phases or at least protect the downside. That is where quality comes in.
Correct. So, Shelly, if I were to look at the portfolio of this, particular index, how will I categorize it based on the market cap? Is it large cap focused, mid cap focused, or there is some part of small cap as well?
So this is, largely incidental. It purely depends on the three matrix and the score of each stock, the consolidated quality score of the stock basis, ROE, debt to equity, and the accrual ratio. And the market cap is incidental. It's a result. It's an output. However, currently as we speak, this index has about 75 to 77% large cap, and the rest is mid cap. Sometimes you could have some small cap exposure seen because your average market cap
Change.
amphi reports come in once every 6 months. So in between those periods, some of the stock movements and the market cap movements could have some exposure shown 2 to 3% as small cap, but largely this is a 75% large capish fund as we speak currently, and the rest is mid cap.
Okay. So, how much allocation should an investor look forward to in this fund? And, should this fund, as we are, calling this as a quality and low volatility, should this be part of the core portfolio of an investor?
Yes, it can be part of the core portfolio. The core and satellite. So core is, let's say, you have market cap coverage. Now, for example, in the market cap coverage in the core portfolio, you would have currently, let's say, large caps are more attractive and have a better risk reward. So you would be more towards large cap, large and mid, and flexi cap categories. Or you would also have passive funds to the in on the lines on the same lines of the market cap category. On the sectoral side, if there are very broad themes that can come in the course part of the portfolio, and the factor part can have let's say momentum to represent the bull phase, and quality can be there. Of course, quality performs and captures the upside equally good and reasonably well, rather, but it outperforms during the down market period, as I said. So, quality and momentum, both as factors, depending on which time of the market phase that we're speaking about, it can be part of the core portfolio. So, market cap coverage, very broad theme coverage, and factor coverage can be part, and gold. This is, let's say, the core portfolio. On the satellite portfolio, you could have certain themes, narrow themes so right now, let's say, our house view is towards banking and financial services fund, pharma and healthcare. That's another theme that that's another sector that we are, positive on, and consumption. So these are the, 2 to 3 sectors that can be in. Within sectors also, sometimes you tend to have some micro parts on which segments are built, on which passive indices are built, that also can be part of this satellite portfolio.
All right. So I think, Shelly, with this, we have, come to an end of this video. Thank you for patiently answering all our questions related to this NFO. And we look forward to all our investors to grab this opportunity from 17th March till 20th of March for investing in this NFO. So to all our viewers, this NFO is available on Tata Capital's Moneyfy app. The link to investing in this fund is given in the description below. And I think with all the views, from Shelly, I think this is going to be a very good opportunity, in this market cycle. Thanks, Shelly, for your time. Thank you, everyone.
Thank you, Harsh. Thanks, Manify. And thank you, all the viewers, for being here and for listening in. Thank you, everyone.